Hey everyone, and welcome back to the Deep Dive.
Great to be here.
We're diving into your sources today, pulling out some truly fascinating insights. They really paint a vivid picture of our current economic landscape. Our mission today: simple, cut through the noise. Give you a shortcut to understanding three massive shifts shaping our world. We're talking big changes in U.S. trade policy, the surprising reality of AI's impact on software.
Which is everywhere right now.
Exactly. And a deep look into how one major economic strategy could ripple through your investments and, frankly, your daily life.
It is a complex tapestry, definitely. But what's fascinating, I think, is how interconnected these threads really are.
Yeah.
We'll be, connecting the dots, helping you understand not just what's happening, but maybe why it matters to you.
Couldn't have said it better.
Yeah.
So whether you're prepping for a big meeting, maybe just curious, or trying to make sense of the headlines you're seeing every day, get ready for some aha moments. Let's jump right in. Okay, first topic. Let's unpack this. We're seeing a really significant change in U.S. trade policy and, well, the government's role in general. It's a big shift away from those traditional free market principles we talked about for so long towards something more interventionist. Feels like a new era, doesn't it?
It absolutely does. For decades, the U.S. largely operated on those free market ideals. But now, the analysis describes it as pay-for-play economy.
Pay for play.
Yeah. And what this means for businesses hoping to operate in the U.S. is this increasing expectation of tariffs or maybe agreed upon purchase contracts, even multi-billion-dollar investments.
Okay.
Think of it like this. If you want to set up shop in, say, a really desirable neighborhood, you might have to pay a pretty steep entry fee or commit to buying certain things from local vendors first.
That's a good analogy.
Yeah, and to give you a clearer picture, reports cite tariffs as high as like 50% on some Indian goods.
50%.
Yeah.
Wow.
Right. And you have South Korea making significant purchase commitments to the U.S. These are pretty clear indicators of this big shift in action.
Pay for play. Yeah, that's a pretty direct way to put it. And it sounds like the government's hand isn't just in trade. Your sources are highlighting increased government influence, even on institutions we normally think of as fiercely independent, like the Federal Reserve.
And this raises a really important question, doesn't it, about institutional independence. The Trump administration, as the material details, has, well, concentrated efforts on strengthening its influence over the Fed. The goal seems to be securing a majority vote on the Federal Open Market Committee, the FOMC.
To push for lower interest rates.
Exactly, to push for lower rates. Now, the underlying concern for critics, they view this as, and I quote, an unprecedented attack on the Fed's independence.
Strong words.
Very. They warn it could lead to higher inflation down the road, reduce credibility for the Fed itself, maybe even higher long-term interest rates. The worry is, if the Fed isn't seen as truly independent, its decisions might look politically motivated.
Which undermines trust in the whole system.
Precisely. It potentially undermines trust in our entire economic system.
So it's about pushing for specific economic outcomes by influencing the Fed. Beyond that, though, the sources also note this growing link, maybe less transparent, between fiscal and monetary policy. How are those lines blurring? What does that mean?
Well, it's becoming increasingly politicized. That seems to be the crux of it.
Okay.
Government policies are perhaps more frequently driven by political interests rather than purely economic data. So for you, as an investor or just an informed citizen, this lack of transparency makes it harder to assess risks.
Because you don't know if decisions are data-driven or agenda-driven.
Exactly. Central banks might be swayed by political agendas, not just the economic indicators, and that makes the economic forecast, well, less reliable.
Now, this next point from your sources sounds really significant, like a seismic shift, they call it. Direct government stakes in private companies. How big a deal is this? What does it actually look like?
It is a fundamental departure, really, from traditional U.S. economic policy, moving away from principles that advocated for minimal government intervention.
Like Milton Friedman's ideas.
Exactly. For example, the U.S. government has acquired I believe it's a 10% stake in Intel.
Right. I saw that.
And the Commerce Secretary has hinted at similar government equity participation in U.S. defense companies like Lockheed Martin.
Wow.
It's a huge change in how the government interacts with private enterprise. It's effectively becoming a shareholder itself.
And finally, on this topic, a tougher stance on tech regulation and trade retaliation. It sounds like the U.S. isn't shy about using its economic muscle globally anymore.
That's right. The U.S. is pushing back pretty hard against digital regulations coming from the EU, for instance, threatening higher tariffs, other sanctions on countries that tax U.S. tech companies. It shows, as the source puts it, a greater willingness from the U.S. to punch back in these geopolitical and trade disputes.
Like saying, you put up a barrier for our companies, we'll put one up for yours.
Basically, yes. Tit for tat.
So, pulling this all together, what's the core takeaway for us from these shifts in trade and government involvement?
In essence, U.S. trade policy and the government's role are clearly evolving. They're moving towards a more nationalistic, protectionist, and interventionist approach.
Right.
This means more direct government involvement in the economy, the politicization or perceived politicization of independent institutions like the Fed, and yeah, a much tougher stance on international trade and tech regulation. These aren't just subtle tweaks. They feel like fundamental shifts.
Definitely sounds like it. Okay, let's switch gears now to something that's, well, it's everywhere, AI.
Artificial intelligence.
The buzz around AI certainly paints a potentially grim picture for the software industry, almost like a software apocalypse is coming. But what do your sources reveal about the true impact? Is this fear justified, or is there maybe a more nuanced story here?
It's an excellent question. And what's fascinating here is it really is a two-sided coin.
Okay.
On one hand, yeah, there's significant investor anxiety because AI's capabilities in coding, data analysis, image generation, automation, they could potentially repress existing software platforms.
Right.
Investors are genuinely asking, if an AI can do this, why am I paying for this niche software anymore?
Makes sense.
And this sentiment has seen traditional SaaS companies think Salesforce, Adobe, ServiceNow, they've underperformed in the S&P 500 this year because of these worries.
But that's only one side of the coin.
Exactly. On the other hand, this idea of an immediate software apocalypse seems largely exaggerated.
Okay.
While lots of companies are rushing to adopt AI, there's an MIT report indicating that something like 95% haven't actually seen meaningful returns from their AI investments yet.
95%, that's huge.
It is. The issue isn't necessarily the technology itself, but maybe a lack of the right organizational culture or effective strategies to actually use it.
Yeah.
It's like having the best new kitchen gadget, but, not knowing how to use it or what recipes work best with it.
That's a crucial distinction. So it's not just the tool, it's how you integrate it and use it effectively.
Precisely.
And your sources highlight that some companies are differentiating themselves quite well,
Yeah.
right? It's not all doom and gloom.
Absolutely. While Salesforce, for instance, even after enhancing its AI products, kind of struggled with its stock defense narrative. But companies like Microsoft, Oracle, Palantir, companies that have integrated AI strategies more deeply, company-wide, they're getting more positive evaluations.
Okay.
Even data companies like Snowflake and Palantir, they're being assessed differently based on their customer base and how involved they are in AI pilot programs. It really shows that just having AI isn't enough.
It's about deep integration and showing real value.
Exactly. Demonstrated value.
So what are the experts saying about this transformation overall? Is it truly the end of software as we know it, or something else?
Well, the Wall Street Journal suggests AI isn't causing the death of software, but could actually breathe new life into it.
Interesting.
Reuters sees the short-term valuation pressure, sure, but views it more as a sign the industry is just entering a new phase.
Okay, a transition.
Yeah, and Barron's believes AI will be a tool providing new growth engines rather than simply replacing what's already there. So the consensus seems to be it's more of a transformation, maybe even an evolution, than a total replacement. It's creating new opportunities.
That gives us a much clearer, maybe more balanced picture. So for you, the listener, maybe the learner investor, what are the key areas to watch as AI reshapes this software industry? Where should we be looking?
Right, connecting this to the bigger picture, the sources point to several key sectors to keep an eye on. First, small and medium-sized SaaS companies, the SMBs. These seem most vulnerable to being replaced by large language models, the LLMs, if they only offer niche, simple tools, like basic CRM or simple document automation.
Things an LLM could potentially do easily.
Exactly. However, the opportunity is there for those that rapidly integrate AI themselves to transform into more intelligent platforms. It seems their speed of AI internalization, as one source puts it, will really determine survival.
Makes sense. Adapt or, well, yeah. What's next?
Second, data infrastructure and cloud. This is a big one.
Right. AI needs fuel.
Precisely. AI's performance relies heavily on robust data and computing infrastructure. So companies like Snowflake and Databricks, who manage data, and the big cloud providers, Microsoft Azure, AWS, Google Cloud, they are direct beneficiaries of this expanding AI demand.
They're providing the foundation.
Yep. Market analysts are calling them the most certain beneficiaries of the AI boom. Think of them as selling the picks and shovels during the AI gold rush.
Good analogy. Third,
AI security. This is critical. AI can amplify cyber threats, right? Making existing security tools potentially insufficient.
scary thought.
It is. And this creates explosive demand for new AI-based threat detection, data security, model integrity verification. Companies like CrowdStrike, Palo Alto Networks, Zscaler, they're key players here.
So new threats require new defenses.
Exactly. Goldman Sachs actually analyzes this area. We'll see the largest increase in IT spending within IT by 2030. It's a major growth area.
Okay. And finally,
Industry-specific AI solutions. Think about it. General LLMs often struggle to replace highly specialized AI solutions in sectors like healthcare, finance, or manufacturing.
because they lack the deep domain knowledge.
Exactly. Think complex medical diagnostics or financial risk analysis, smart factory operations. Companies with strong industry expertise that integrate AI effectively, they can achieve both defensibility and growth because they're solving very specific complex problems that general AI might not handle well.
Okay, that makes sense. So boiling it all down, what's the practical upshot for our listeners from all this AI talk?
Well, short term, yeah, AI is creating some valuation pressure on existing SaaS companies. Investors are clearly worried about disruption. But long term, it looks like data infrastructure, security, and these industry-specific AI solutions will likely be the new growth engines. So your focus should probably be on which companies are integrating AI the fastest and most effectively, turning this challenge into a powerful opportunity.
Got it. Okay, let's turn to our final deep dive topic for today. President Trump's stated strategy for taming inflation.
Right.
And it focuses heavily on bringing down oil prices.
Yeah.
This is a topic that could directly impact, well, everyone's daily expenses at the gas pump and, of course, your investments.
Absolutely. And what's fascinating here, I think, is the clarity of the basic strategy itself.
Okay.
President Trump, as your sources highlight, has pretty clearly advocated for lowering oil prices, specifically targeting below $60 a barrel as a key short-term method to alleviate inflation.
Why that specific lever?
Well, his core motivation, as experts analyze it, seems to be that many Fed members are hesitant to cut interest rates because inflation remains persistent, even with maybe a weakening job market.
Right, inflation's sticky.
It is. With the Consumer Price Index, the CPI, still above 3%, and potential inflationary shocks maybe coming from tariffs too, he seems to believe lower oil prices could, quote, single-handedly dampen inflation factors quite quickly.
A quick fix, potentially.
Potentially. And interestingly, Goldman Sachs analysts looking at his social media activity even suggest his actual preferred price range might be closer to $40 to $50 a barrel.
40 to 50, that's quite low.
It is. But this isn't just, a political message pulled out of thin air. It connects to industrial realities. That range broadly aligns with the break-even costs for much of the U.S. shale industry.
So it keeps domestic producers just profitable enough.
That seems to be the thinking, yes. Ensures domestic production can continue.
Okay, that logic makes perfect sense. If oil is cheaper, gas is cheaper, shipping is cheaper, everything gets cheaper, and that should bring down prices overall. But is lowering oil prices really that simple? Or even achievable, given how complex global markets are?
Yeah, this raises a really important question. Execution is key. Energy research institutions like Wood Mackenzie analyze that even with the Trump administration's intent for deregulation, expanding production might not be easy.
Why not?
Well, due to already low investment sentiment in the sector and ongoing cost pressures, they actually emphasize that lower oil prices can decrease profitability, which could ironically delay any rebound in production.
So lower prices might discourage the very production needed to keep prices low.
It's a potential feedback loop, yes. Reuters also cautions that while lower fuel prices can certainly ease short-term inflation, these structural factors in the global market, plus demand uncertainties, mean the overall effect on inflation might be more limited than hoped.
Okay.
And this ties into concepts economists talk about, like cost-push inflation, where rising energy costs push up all prices.
Right.
Also this idea of greedflation, the perception that companies might be increasing prices beyond just covering rising costs, which could lead to calls for things like excess profit taxes. So Yeah, it's definitely not a simple switch to flip.
So the strategy is clear, but the execution and the full impact, much more complex. Okay, for you, the investor listening, what happens to various real assets if oil prices do fall significantly, even acknowledging the challenges?
Right. Assuming the strategy is somewhat successful, if we connect this to the bigger picture, your sources outline some pretty differentiated impacts across different asset classes.
Mm.
First, the bond market, especially U.S. Treasuries.
Okay.
Lower oil prices generally lead to reduced inflation pressure. That, in turn, increases expectations for interest rate cuts from the Fed.
Which is good for bonds.
Generally, yes. It would likely cause bond yields to fall and, therefore, bond prices to rise. Some investment banks analyze that if this oil strategy succeeds, U.S. Treasuries could be the most direct beneficiary in the short term, really benefiting from an accelerated Fed easing cycle.
Okay, treasuries look good. What about currencies?
Second, the foreign exchange market. This gets a bit mixed.
How so?
Well, a fall in oil prices, easing inflation pressure would normally reduce upward pressure on the dollar. Lower rate expectations tend to weaken a currency.
Okay.
However, since the U.S. is also a major energy exporter now, excessively low oil prices could actually negatively impact its trade balance, so you get mixed signals for the dollar.
Interesting. What about other currencies?
The Japanese yen, traditionally a safe haven currency, could strengthen against the dollar with lower U.S. inflation and rate cut expectations. And emerging market currencies, especially for big oil-importing countries like, say, Korea and India, they could strengthen because their trade balances would improve.
Cheaper imports.
Exactly. HSBC reports suggest lower oil prices could, quote, simultaneously stimulate dollar weakness and emerging market currency strength.
Fascinating interplay. Okay, what about gold, the traditional inflation hedge?
Third, gold. This one's also nuanced.
Yeah.
Gold traditionally acts as an inflation hedge, right?
Right.
So lower inflation pressure might reduce the short-term demand for gold as an inflation hedge.
So gold down.
Not necessarily long-term, because the expectation of interest rate cuts simultaneously supports gold prices. Lower rates make non-yielding assets like gold more attractive.
Okay. Two opposing forces.
Exactly. So while you might see short-term volatility, gold could actually strengthen in the long run due to that Fed policy easing and potential dollar weakness. JP Morgan suggests that while oil and gold may move in opposite directions in the short term, gold is likely to rebound once interest rate cuts materialize.
Okay, so a potentially bumpy ride short term, but maybe upside later. Finally, the stock market.
And finally, the stock market. This is where you see clear sector differences.
Winners and losers.
Pretty much, energy companies would likely see reduced profitability with lower oil prices. That puts pressure on their stock prices, particularly the shale producers operating on tighter margins.
Makes sense.
Conversely, sectors like consumer discretionary, think retail, travel, plus airlines, transportation companies, they would benefit significantly from lower fuel costs.
Because their costs go down and maybe consumers have more money to spend.
Exactly. It leads to increased consumer spending power, potentially fueling positive rallies in those sectors. Morgan Stanley indicates that if Trump's oil strategy succeeds, the S&P 500's energy sector would likely underperform, but consumer and airline sectors could see a positive rally.
Okay, so what's the bottom line here for us and our investments when thinking about this oil strategy?
Well, for you, it really means that thinking lower oil prices equals overall positive is just too simplistic.
It's not that straightforward.
Not at all. Investors really need to consider the very different differentiated reactions across these various asset classes and industries. What's good for one part of the economy or one type of investment might actually be a challenge for another.
Wow, okay. That was a truly insightful deep dive into three really major areas shaping our economy right now.
Yeah, a lot to cover.
From that interventionist shift in U.S. trade to AI's transformative power, not quite apocalypse, maybe evolution, and the really complex ripples of these oil price strategies. We've definitely covered a lot of ground.
We really have, and we've seen how something happening in trade policy can influence central banks. How technological advancements aren't always about direct replacement, but often act as a catalyst for new growth.
Right.
And how a single commodity, like oil, can create this cascade of effects across global markets and ultimately your investments.
And remember, understanding these shifts isn't just about knowing the facts. It's really about seeing that bigger picture and how they connect directly to you, to your wallet, and maybe your future plans.
Absolutely. Which, raises raises an important question maybe for you to consider after this. As governments seem to become more interventionist and technologies like AI continue to accelerate change at this incredible pace,
Yeah.
how do you see the balance shifting between free markets and state influence maybe over your lifetime, and what new opportunities or perhaps challenges might that present for you?
That is a great thought to chew on. Thank you so much for joining us for this deep dive today.
My pleasure.
We really hope you feel a little more well-informed, maybe a bit more ready to navigate these complex topics. Until next time.